The fastest way to lose control of your startup is to raise money without understanding your cap table. I heard this story about a founder, super sharp, company had traction, raised a couple hundreds of thousands of dollars on safes. Everything was great until the Series A. The lead investor loved the product, but walked away after seeing the cap table. Why? The founder had stacked safes at different valuations, didn't model dilution, and by the time everything converted, he would own less than 30% of the business without even having hired anyone. And look, cap table feels technical, but this is where companies win or lose even before shipping their products. So here's what you'll take away from this video. You'll finally understand how cap tables work, and most importantly, you'll know which tools to use at the right time depending on where you are, whether it's pre-traction, post-revenue, or negotiating your first board seat. But first, please subscribe if you haven't already. I'm publishing a new video every week, taking you behind the scenes of the VC world with me. Thank you. So, what's a cap table? It's literally a spreadsheet. That's it. But it tells a very important story about your startup, who owns what, and how that changes over time. This includes fully diluted ownership, which means every claim on your equity, even if it hasn't hit the cap table yet. So we're talking common stock, the outstanding options, the unissued option pool, and of course, safes and convertible notes that might not have converted yet. Fully diluted means all the shares that could exist. So that's the first trick. Your cap table at some point might not reflect everything that you've promised because it hasn't yet been converted to shares. Issued shares is of course what you've already granted, but investors care about fully diluted because this is what reflects the reality of who owns what. So if you're only looking at issued shares, you're getting a false sense of control and the wrong information. Your real ownership is based on the total potential pie, not just today's slice. So let's look together at what that pie actually includes and who's sitting at the table with you from day one. So at this early stage, you usually have three main players: the founders, the employees, and the investors. So here's the part that many founders get wrong. Every time you raise money, you get diluted. That's not a bug. That's actually how equity works. The goal isn't to avoid dilution, it's to use dilution wisely. Because like Mark Cuban said, owning 100% of a grape is a whole lot worse than owning 50% of a watermelon. But even worse, I've heard founders tell me, oh, I still own 80%, I haven't given anything away. But they actually had several safes stacked upon each other, a 15% option pool, and a Series A with a price round on the way. Their actual ownership was actually closer to 40%. Like Kirsty Nathu from YC says, the cap table might not show it yet, but you've already sold some parts of your company. You don't want to be the richest person on a worthless cap table. So own less, build more. Don't assume your lawyer or Carta is handling this. Founders who don't understand their own cap table aren't in control. They're guessing. And one of the biggest reasons founders lose control, it's from the types of deal they raise. So let's cover the three most common structures and how they affect your cap table. Each of these three options has different trade-offs in how fast you can go, how much control you have. So let's start with the most common one, the safe. Safe means simple agreement for future equity, and it was created by YC to make fundraising fast and easy for founders. They're quick, they're clean, and they basically became the default for every early stage startup. Here's how they work. You raise money now, and the safe converts into equity in a later round, usually at Series A. Unlike convertible notes that we'll cover in a moment, safes are not debt, which means there's no interest and no maturity date. It's just a simple conversion when a price round happens. And here's a very important detail. Most founders today use post-money safes, which are great to understand your dilution. But until very recently, many people were using pre-money safes, which then makes it very confusing and you don't really know exactly how much of your business you've sold. And so of course, founders love safes because they're quick, there's not a lot to negotiate, there's very low legal fees, and you get money in your bank account extremely quickly. But, and this is critical, if you don't model your cap table carefully, safes can pile up and come back to bite you in the ass later, especially if you're taking different safes at different valuations. I've seen founders do this. A first safe at 5 million cap, and then another safe at 10 million cap, and then a third safe at 15 million cap. Now you've got a whole mess. Nobody really knows what they own, and it's much harder for you as a founder to understand what you've sold. Now your price round becomes a nightmare. Kirstina Thu calls it one of the worst mistakes YC founders can make, and honestly, I think I agree. For founder and for investors, you should track everything and model everything. Now let's move on and talk about convertible notes. So they're pretty much like safes, but they're actually debt. So they have an interest rate, a maturity date, and repayment terms. The benefit is that they offer a little bit more investor protection because you're lending money that technically has to be repaid. The downside, of course, is that they're a little bit more complex, and for many founders, the word debt kind of freaks them out. Honestly, I very rarely see convertible notes used at this stage anymore. They add complexity for very little reasons, so they've become more and more rare. If you have to choose between a safe and a convertible note, go with the post-money safe. It's cleaner, easier for everyone. Finally, we've got the classic, the price round. So this is where you set a fixed valuation, you issue new shares, and usually you're giving seats on your board. This is the formal legal process that people think about when they're talking and thinking about raising money. The pros, it's clear ownership, it's real equity, and it's often a sign that a company is maturing. The cons is it takes longer, and usually the legal fees are much higher. It also usually comes with much more diligence from the investors. If you're a founder, don't rush into a priced round too early, because once you bring people on your board, that's forever. If you're an investor, this is where you start thinking seriously about governance and about taking a board seat. So when should you think of going from safes to price rounds? Well, honestly, it really depends. I've seen companies raise tens of millions of dollars on safes only, but a good rule of thumb is that when you're raising probably more than 5 million, or when your lead investor wants a board seat, you should think about making this a price round. But here's where it gets interesting. Sometimes the safe that you signed early on might become a better deal than the priced round that you sign later. Let me show you what I mean. Let's say I invest in a safe at a $15 million cap. Then a year later, I do a price round at a $10 million cap. That means my safe converts at the lower valuation. I get more equity for the same check. This is a downside protection that's embedded in the safe. Now, I hear sometimes some people complain about the safe. They say, oh, we don't have any equity. What if the company wants to pay a dividend and we don't get that dividend because we don't have shares? In theory, that's true. But in reality, first of all, startups very rarely pay dividends, but also most founders convert the safes before paying the dividends if they want to do so. So yes, it's a theoretical risk, but it's not a practical one. And by the way, if you're interested in dividends, you're probably not investing at the right place. So now you know how each structure works, but how do they impact your cap table over time? Let's take a clear example. You raise $500K on a safe at a 5 million cap. Then you raise $1.5 million on another safe at $10 million cap. And finally, you do a price round at $15 million cap. So far, pretty typical, right? But now comes the moment of truth. You do your price round and suddenly all of your safes convert. And here's the order of operations straight from YC's CFO. First, the safes convert into equity. Then you increase your option pool to make room for future hires. And finally, the new Series A investors buy in at the set price. If you model this out of order, well, your math will be off and you'll get diluted more than you expected. So what happens? Founder ownership takes a hit. This is the part that a lot of people underestimate. The real cost of a safe isn't obvious when you sign it. It hits you later when all of those safes convert all at once. Let me give you a simple model. Here's the actual math. The ownership percentage that you're selling is the amount you receive as an investment divided by the post-money cap. So if you're getting 1 million on a cap of 10, 1 on 10 is you're giving away 10% of your startup if it's a post-money safe. $1 million safe at 5 million, that's 20% of your company sold. Then a 5 million Series A at $20 million valuation, that's another 25% sold. If you add a 10% option pool for hires, that's 55% of your company that's already gone before you even get to Series B. And if you didn't track the safes carefully, You might not realize that until the legal docs come in. So yeah, safes are very simple, but you need to model them. Because cap tables, they don't lie, they just delay the reveal. So how do you avoid those surprises? Well, it all comes down to how you think about your different rounds before you sign a single document and before you take in the first dollar. Here's how I approach it and how I think founders should too. As an investor in YC startups, I see a lot of deals, and honestly, 99.9% of the time, it's safes. And I'm fine with that. I don't push founders into a price round too early. At that stage, I care more about the team and the early traction. But here's the thing, I do care about clean cap tables as well. And that starts with choosing the right instrument and using it well. So for founders, here's what I tell you. First of all, know exactly what you're giving up. Second, model everything before you sign any document. And please, don't stack random safes with very different valuations. That's how cap tables turn into nightmares. And investors, don't be the person asking for a price round too early, you might lose the deal. But also, don't fly blind. Track your ownership, ask the right questions, and remember, you're writing real checks, so don't treat it like monopoly money. A typical strong Series A cap table might look like this: 15% to safe holders, 20% to the new Series A investor, and 10% option pool for future employees. That leaves roughly 50 to 55% for founders. That's what I would call healthy. But if you're already sold 60% or more before your Series A, you've probably given up too much too early. And of course, once those safes convert, there's no putting back the toothpaste into the tube. And also, don't fall into the trap of over-optimizing valuation to minimize dilution. YC sees this mistake all the time. Founders who want a higher cap, and the result is that their fundraising stalls and they're not able to get back to building quickly enough. That trade-off almost never pays off, and it could actually cost you your business. Take the money, build the business. Cap tables are tools, not trophies. Do this today. Pull up all of your safes, write down for each of them the amount, the investor, and the date, and then use Pulley, who's a YC company, or Carta, or the YC tool to map out your cap table. If this takes you more than 10 minutes, then your cap table is too complex. Cap tables aren't just spreadsheets, they're the blueprint of your startup. Get this part right and you give yourself leverage, control, and clarity. Get this wrong and you wake up someday working for a company you don't own anymore. So take the time to model it and understand it. Don't be afraid to ask questions. If this helped clarify even a single thing around safes or a cap table, then please like this video, drop a comment below, and share this with a founder who's about to raise. I've got plenty more content to share with you, so please hit the subscribe button. I publish a new video every week. Thank you.